Warren Buffett has sold 13% of his Apple position, worth approximately $20 billion. This is his largest ever sale since Berkshire first bought Apple in the first quarter of 2016. So is this a red flag for Apple investors? Does Buffett believe that Apple is extremely overvalued? Or are there other reasons behind Buffett's sale? In this video, we'll review the reasons that Buffett stated for selling the stock, and we'll discuss other potential reasons or risks that could have possibly influenced his decision. We'll also analyze the company's recent financial performance, take a quick look at the stock's dividend safety, and then run the numbers through our valuation model to decide on an acceptable buy price with a reasonable margin of safety. First things first, in the Berkshire Hathaway annual shareholder meeting that took place earlier this week, Buffett was asked about selling 13% of Berkshire's Apple position. Here is what he had to say.
Let's start, just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have.
Now, I don't know about you, but when listening to him say that Apple will remain Berkshire's largest holding actually makes me a bit more worried than reassured. Apple is still by far the largest position in Berkshire's portfolio, so technically they could still sell more than 5 times this amount in the next 2 quarters, and it would still be the largest holding. Not sure if that was an indirect message, however, the next 2 clips will provide a little more context on why exactly Buffett decided to sell, so let's take a listen.
We own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive.
Yes, you heard that correctly. With everything going on in the world and the equity markets, Buffett does not mind increasing Berkshire's cash position. To me, this is a clear indication that Buffett believes that the stock market is currently overvalued, and that the interest that he could generate from the increase in cash is far more attractive to him than investing in other stock positions. But why now specifically? Well, I found this super interesting chart on Twitter, which illustrates Berkshire's historical cash positions, and as you can see, every single period when the company's cash position was at its peak was followed by a major crash. This includes the dot-com bubble of the 2000s, the 2008 financial crisis, and even the 2020 COVID pandemic. Bear in mind that the cash position after the sale is currently $189 billion, even higher than what's shown here. So, is he expecting another crash in the near future? Only time will tell. Now, let's listen to Buffett's second reason for selling Apple, which he actually focused on more during the meeting.
We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple. And that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And they can change that percentage any year, and the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely, and if the government wants to take a greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And it doesn't bother me in the least to write that check. And I would really hope with all that America's done for all of you, it shouldn't bother you that we do it. And if I'm doing it at 21% this year and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year.
So, as Buffett explained in this clip, the other reason behind the sale at this time is to lock in potentially lower corporate income tax rates, as he seems to believe that the rates could possibly increase in the near future. So, in a way, he is actually saving the difference by realizing some gains now. To be honest, when I first heard Buffett offer this explanation, I was skeptical. But after doing some research, I found out that at 21%, the corporate income tax rate is at the lowest rate it has ever been since 1940. And given the increasing federal budget deficit and the unpredictability regarding which party will win in the next presidential election, I could certainly see the potential for future increases. These are the two reasons that Buffett referred to in the meeting, but could there be other reasons that he did not share with us? Like, why did he sell Apple specifically and not Coca-Cola or American Express? Maybe because his returns on Apple are much higher than the other two companies? Well, let's find out. As you can see on the screen right now, since Berkshire opened its position in Apple in 2016, the stock has returned approximately 362%, excluding dividends. Comparing that with Coca-Cola's returns of 92%, Apple's gains are much higher, so it does make sense to sell Apple, to take full advantage of the lower tax rates. On the other hand, when we compare it with American Express's 336% return, the difference is not as significant, so if the decision is purely based on paying less taxes on capital gains, then an argument could possibly be made for American Express. However, to be completely fair, American Express is a much older position with a higher dividend, so I assume it has an even higher dividend yield on cost. Could that have played a role? Or are there other fundamental issues with Apple that could have influenced Buffett's decision? Make sure to watch until the end of the video as we try to answer this question. Starting with Apple's financial statements, we can see that revenues grew from $268 billion in 2019 to $382 billion in the trailing 12 months. That's a CAGR, or a compound annual growth rate, of 8.5%. Similarly, we can see that net income increased from $58 billion in 2019 to $100 billion in the trailing 12 months, which is a healthy CAGR of 13.6%. However, if we take a closer look, we'll see that since 2021, both metrics have not really moved much. In fact, they have decreased slightly as of the trailing 12 months. So growth seems to be stalling for Apple, which is not exactly what investors want to see. As for the balance sheet, we see that the cash balance in 2019 was $107 billion and decreased to $67 billion in the trailing 12 months, which is a CAGR of negative 10.2%. Current assets, which includes the cash balance, also decreased from $163 to $128 billion, a CAGR of negative 5.4%. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, increased significantly from $1 billion in 2019 to $37 billion. That's a compound annual increase of 123.3% per year. So, cash and current assets are decreasing, while net debt is increasing, which is the exact opposite of what we would like to see. However, to be totally fair, this debt is still relatively small when compared to the overall market cap and is comfortably covered by Apple's free cash flows, as we'll see later on in the video. In terms of the dividend, Apple has a dividend safety score of 99 out of 100, which is the highest possible score, and implies that a dividend cut is highly unlikely. The company started paying a dividend 11 years ago and has been increasing the dividend every single year since then. The dividend has been increasing on average 7% in the last 5 years and 9% in the last 10 years, with the latest increase, which was announced last week, coming lower than its historical averages at 4.2%, which makes sense given the lack of growth in Apple's top and bottom lines. Now, given Apple's very small dividend, I'll skip over some dividend-related metrics to focus on the more important financial metrics, starting with the total sales. We've already looked at revenues. However, I want to show you here that Apple's stagnant growth is nothing new. From 2015 to 2017, sales declined 2.1%, and from 2018 to 2020, sales only grew by 3.4%. Over the entire period, from 2015 till 2020, the average growth per year was a mere 3.5%. This is because of Apple's product cycles. Every few years, Apple releases a new product or makes significant innovative upgrades to existing ones, so sales and revenues jump. Then a few years go by without any major innovations, and then another product release comes by, and so on. And the exact same trend is reflected in Apple's profits. However, if we compare Apple's earnings per share growth on the left with sales growth on the right, we can clearly see that earnings per share have been growing at much better rates. Let's take 2023 for example, where sales declined by 3% while earnings per share did not change. This is even more evident in the last 12 months' growth, where sales saw a 1% decline, while earnings per share actually grew by 9%. This is all thanks to Apple's outstanding share buybacks program. Since 2014, shares outstanding have decreased from 24.5 billion shares to 15.6 billion shares today. This is an incredible decrease of 36.3% of the company's total shares outstanding in this 10-year period. This basically means that shareholders who bought and held Apple shares since 2014 now receive 36.3% more of the company's profits for the exact same shares. Additionally, earlier this month, Apple announced a new $110 billion share buyback program, which is the largest in the company's history. Coming to my favorite metrics, and two of the main reasons Buffett loves owning Apple stock, which are return on equity and return on invested capital. And just in case you're new to the channel, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. I generally like to see a minimum of 10% for both metrics. However, as I always mention, these thresholds could change slightly depending on the industry. As you can see here, both metrics have been consistently surpassing our 10% threshold by a long shot, averaging an outstanding 82.7% and 39.2% respectively over this 10-year period. This clearly demonstrates the strength of Apple's ecosystem and the moat it possesses, as well as management's ability to consistently generate market-beating return for its shareholders, which is definitely great to see. As for the net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, we like to see it under 3 for most companies, and it is currently well under that threshold at 0.26. This basically means that it would take Apple approximately 3 months to pay all the company's debt, with their net cash on hand. Moving on, we can see here that from 2020 till 2022, net debt to capital exceeded our preferred threshold of 0.4, showcasing management's increased reliance on debt to finance business operations during that time. However, this was happening when the cost of debt was almost zero. In 2020, the Fed was dropping interest rates and only started increasing the rates again in 2022, which is when Apple started decreasing their reliance on debt, and in the last 12 months, their net debt to capital actually dropped to 0.34, which is below our preferred threshold. So overall, it seems like management is able to manage the company's debt well, and looks to be making the right moves, which is also evident in the return on invested capital that we saw earlier. So far, I don't really see any obvious red flags that could have pushed Buffett to sell, but could it be Apple's current valuation? Let's find out. Jumping into our valuation models, we'll be reviewing 4 distinct models to get our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is the discounted free cash flow model, where we estimate Apple's intrinsic value based on the present value of their estimated future cash flows. You can see here the free cash flow that Apple generated over the last 10 years, growing at an average of 9.9% per year. Based on analyst estimates, we use an 11% growth rate for future free cash flows. Using an 8% discount rate, we get the present value of all future free cash flows as well as our terminal value. Adding them together plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $223 per share, which is higher than Apple's current stock price, indicating possible undervaluation. Now, historically, the S&P 500 returned 8 to 10% per year. And while past performances are not a guarantee of future returns, you might want to consider a higher discount rate, say 9%, given the additional risks of investing in one company versus a diversified ETF. With a 9% discount rate, our fair value decreases to $182 per share, which is just under the current price. For this video, I'll keep the discount rate at 8%. However, if you would like a copy of these valuation models to use your preferred discount rates or maybe change any of my assumptions, you can now get one using the link in the description below. The second method is the multiples valuation model, where we obtain Apple's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Apple's earnings per share to get our fair value, which is $212 per share, also higher than the current stock price. The third method is the dividend discount model, where we estimate a stock's fair value based on the present value of future dividend payments. However, as you know, Apple pays a very small dividend, so we won't be able to use this model in our valuation. The last method that we will review today is the historical multiples valuation model, where we estimate Apple's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we will use the 5, 10, and 20 years normal PEs. As we can see here, the Apple stock was trading at an average 25.3 PE during the last 5 years, 19.9 for the last 10 years, and 22.9 in the last 20 years. We calculate their average and multiply it by Apple's current earnings per share to get our fair value of $146 per share, which is lower than the current stock price, indicating possible overvaluation. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $194 per share, which is higher than the stock's current price, but lower than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $174 per share, which is lower than the current price. Hence, with a 10% margin of safety, the stock would not be a buy today. Now, if you're looking for a 15% margin of safety, the acceptable buy price would be $165. With a 20% margin of safety, your buy price would be $155, which is 15% lower than the current stock price. Basically, as you can see here, Apple is currently trading at a 5% margin of safety. If you are looking for anything higher than 5%, you would need to wait for the stock to drop even further. In terms of Wall Street's expectations for Apple stock, they are forecasting it to trade at $205 per share in 12 months, which is higher than our estimated intrinsic value, implying a 12% potential upside for the stock from current levels. Again, if you would like a copy of the valuation models used in this video, feel free to get one from the link in the description below. So, based on our assumptions, Apple looks to be fairly valued, but without an adequate margin of safety. Now, I can imagine that the Oracle of Omaha, Warren Buffett, requires higher discount rates for his investments, at least 10%, if not more. If I go back to the discounted free cash flow model and change the discount rate from 8 to 10%, the intrinsic value drops from $194 to $170 per share, making the stock 8% overvalued, with no margin of safety. So could this overvaluation have influenced Buffett's decision? Maybe. But I don't think the stock is that outrageously overvalued to warrant a sale on its own. I think it's a bunch of factors coming together at the same time that facilitated the decision for Buffett. In addition to the subpar top and bottom line growths and the stock's current valuation, I think there is one more factor in particular that could have influenced Buffett's decision, which is the increasing regulatory and geopolitical risks around Apple. Earlier this year, the US Department of Justice, joined by 16 other states, filed a civil antitrust lawsuit against Apple for allegedly monopolizing smartphone markets. This came just a few days after Apple was hit with a $2 billion fine by the European Union antitrust regulators over its App Store rules. Although unlikely at this time, these regulatory crackdowns, both by the European Union and the US Department of Justice, threaten Apple's ability to sustain its competitive moat long term. Additionally, alongside Nvidia, Apple is Taiwan Semiconductor's largest customer, which means that any geopolitical risks for TSM could also significantly impact Apple's ability to develop chips for its own products. And something we know for sure is that Buffett takes these geopolitical risks very seriously. One of the main reasons he sold TSM shortly after buying it in 2022 was because of the geopolitical risks between Taiwan and China. The same geopolitical risks that could potentially impact Apple through its partnership with TSM. Now, I am not at all trying to argue that Buffett was dishonest regarding taxes and increasing his cash position being motives behind trimming Apple. What I am saying is that I don't think these are the only motives, because selling for those two reasons alone would contradict Buffett's historical stand that his favorite holding period is forever. And if those were truly the only reasons, I believe he would have trimmed American Express as well. Therefore, I believe that in addition to increasing Berkshire's cash position and taking advantage of lower corporate income taxes, the factors that I mentioned in this video could have influenced Warren Buffett's decision to sell 13% of his Apple position. And with that, we come to the end of the video. If you enjoyed this analysis, don't forget to like and subscribe, and watch my other stock analysis videos, and let me know your thoughts in the comments below. Thank you very much for watching. Until next time.